The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Happy Friday, everybody. Welcome to Squawk Box with Ben Boulos and myself, Steve Sedgwick, and these are your headlines. The Bessent buyback failing to tame the bond market. Treasury yields rebounding, largely wiping out Wednesday's intervention relief. The US Treasury Secretary telling CNBC he's prepared to boost the operation beyond $4 billion.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The bond rout spilling over into equities. The US majors closing deep into the red, whilst futures in Europe hover around the flat line, set to close off a down week for the region.
Short sellers get squeezed. Bitcoin breaks past the $70,000 mark, adding around 20% since Monday. Coinbase CEO Brian Armstrong tells CNBC, "We may be on the cusp of the next bull market."
We've been in a bear market on spot crypto trading for the last year or so. And if you look at the prior bear markets, they each lasted about, 370, 380 days. We're basically coming right up against that, where people, they're going to say, well, this one's about over, and it's time for the next bull run in crypto.
And another twist in Italian bank M&A. Monte de Paschi launches a twin takeover offer for Banco BPM and Banco Generali, a deal that would create a giant valued at some 70 billion euros and fend off Intesa's own takeover bid.
A very warm welcome to Squawk Box Europe. US Treasury yields are on the rise again, rebounding from a pullback on Wednesday, which was triggered by an announcement from the US Treasury Department that it will at least double the size of its government debt buybacks starting from the 9th of September. The 10-year yield is now back above the level it was at prior to that intervention, amid persistent concerns over America's debt pile, which topped, as you're all aware, $40 trillion this week. The 30-year yield, the main focus of the Treasury's accelerated buyback, also rising this morning. And as you can see, 5.252 is where the 30-year paper is trading. Let's have a look at global yields. It's not just a US phenomenon, and neither is the debt profile, and neither is the deficit levels. Let's be brutally honest about this. Across the world, and it's not just developed world, it's not just the G7, it's across the world. Deficits are rising, overall debt levels are increasing, and there are concerns amongst investors about who will pay for it, who will buy those bonds. And if they are going to buy the bonds, are they going to demand a greater yield for doing so? Especially when, as we all know, there is competition now. A large amount of competition from the AI industry, the technology industry, which is raising more and more money to fund its growth. Speaking to CNBC, the US Treasury Secretary Scott Bessent said there is a very good chance that the US has seen its budget deficit peak under President Donald Trump after it topped $432 billion in July. Bessent also hinted that the buyback of the government debt could be higher than initially announced.
We routinely do buybacks, and we're going to increase the size of the buyback. And, Sarah, I would note that it could be more than the $4 billion per issue.
The Treasury Secretary also expressed frustration with current trading levels in the bond market.
We believe that the yields don't reflect the underlying fundamentals. This Iran conflict, we will get on the other side of this. We don't know when, and we can talk about the economic measures we're going to be taking against Iran in a minute. We believe that the liquidity, especially in the 30-year point, is very poor.
So I suppose the idea was that intervention would have lowered yields and helped push up equities, but it hasn't worked. Look at this. We saw the yields on Treasuries climb back up. That has weighed on equities, and in a really severe fashion. Look at that, the Dow shedding more than 700 points on the day, down 1.33%. The S&P 500, the broader index, also closing the day 0.9% lower thereabouts, and the Nasdaq as well, the one that we have really seen powering some of the recent rallies. The tech-heavy index off by around 1%, and this puts the main Wall Street benchmarks on course for a down week. They're all on pace to end the week around 2 to 2.5% lower. Let's see what happens in the Friday session. In the meantime, this is the picture across the Asian equity markets, and slightly more mixed. We've got the Nikkei and the Shanghai Composite below the flat line. The Hang Seng slightly more robust, and the Kospi as well, adding to the advances that we saw yesterday, trading about 0.8% higher. In terms of what's being expected when European trading gets started for the Friday session, again, a little bit of a mixed picture, not much deviation from the flat lines, just the FTSE futures indicating to a positive open for the London market, the pan-European blue chip stocks 50 being called lower, as is the Frankfurt DAX. Let's cast an eye even further into the future and what's being anticipated when Wall Street trading begins, and looking to recover some of those losses, futures indicating likelihood of a rebound on the Nasdaq and to a lesser extent on the S&P and the Dow. Steve.
Speaking to CNBC, the St. Louis Fed President Alberto Mussolem said the US faces price pressures on several fronts.
Inflation is high for two reasons. We've had a sequence of supply shocks. We might have another supply shock in the fall with a super El Nino coming. And in addition to that, we have very persistent demand forces in the economy. The AI build directly into capex and investment, and indirectly through equity prices and wealth effects onto consumers. And we see sticky consumer price inflation.
Now, I'm on the Treasury website. Have a look at it, please, all of you. It's really fascinating, and it's got some really good, very clear information that even I understand as well. And there is a lot of very clear information on there, including from the 5th of August. The US Treasury Department is offering $125 billion of Treasury securities to refund approximately $96.3 billion of privately held Treasury notes and bonds that are maturing 15th of August. Included in that, there was $42 billion of 10-year paper. There was $25 billion of 30-year paper. And I found another announcement as well. The US Treasury Department announced its current estimates of privately held net marketable borrowing for July to September. And then talking about the amount that they expect to borrow, $739 billion in privately held net marketable debt, assuming an end of September cash balance of $950 billion. My point is they are still borrowing vast amounts of money. So Bob Parker, Senior Advisor, International Capital Markets Association, good morning to you, sir.
Morning.
With due respect to the Treasury Secretary, doubling those money market operations for repurchasing of 30-year paper or longer-term paper more generally from $2 to $4 billion, when those kind of announcements I was just alluding to there are still on the cards. It seems like the analyst I read in the FT, I think read on CNBC.com, who'd commented to our team stateside yesterday, he said it's like using your credit card to pay your mortgage bill. Would you concur with that?
I wouldn't disagree with it, absolutely. And I think, you made some very interesting points, but I would just add to what you've just said that if you look at the pattern of Treasury borrowing over the last year, there has been very much a focus of new issuance at the short end of the yield curve and much less issuance at the longer end of the yield curve. And, what is Bessent trying to achieve and the Treasury trying to achieve over the last few days in this intervention is actually to prevent a further steepening of the yield curve. Now, we've got a steepening yield curve, I think, for a range of reasons. First of all, there has been very significant corporate, and particularly from the tech sector, new issuance, and that new issuance has been at the longer end. So there has been some crowding out. And it's interesting, previously we always used to talk about governments crowding out corporates. Now we have a situation where the heavy issuance of corporate debt is actually putting pressure on the government market. So that's factor one. Factor two is obviously what's happening to inflation and inflation expectations. And, with the rise in oil prices, with the rise in soft commodity prices, partly due to, or largely due to climate change, headline inflation over the next month or two inevitably is going to rise. And I think we're going to see headline inflation numbers, north of 3.5%. And the very fundamental point is that you have to ask the question, is intervention on the yield curve effective, not just when your total debt now exceeds 40 trillion, but more importantly, when your budget deficit is in excess of 6.5% of GDP and not going down. And also the vulnerability of the US Treasury is also highlighted, not just because of that clustering of new debt at the short end of the yield curve, but let's not forget that foreign bondholders own around 25%, north of 25% of US Treasury holdings. So it is very vulnerable to foreigners selling.
Yes.
Bob, do you think that the intervention, apart from not having the desired effect, even more than not having the desired effect, not even having a neutral effect, but the sense of panic that it might convey could actually end up spooking the bond markets and pushing the yields even higher than they were before the intervention?
The answer to that is it is a high-risk strategy, and it doesn't matter whether you're intervening in the foreign exchange markets or in bond markets, but successful intervention is always when a market is very stretched. And the intervention, for example, by the US and Japan on the yen stopped the yen weakening further because the market was significantly short the yen. This intervention to try and flatten the yield curve, I think probably won't be successful except for a very short-term effect, and we saw that earlier in the week. The impact was actually lasted for about 24 hours. But investors, yes, are avoiding longer duration holdings, but we don't see major short positions. So, I actually question whether this intervention is going to be successful.
Gosh, I don't know where to start. I've been told I've got about 10 minutes, so that's good. That's not quite what she said, but anyway. But look, a couple of points. I don't believe there are bond vigilantes out there targeting the US yield curve. What I believe is that people are saying we are concerned about the underlying fundamentals, and therefore we are going to demand a greater premium to own this paper. I mean, we talk about vigilantes rather glibly, but I mean, vigilantes taking on the US Treasury market, that's quite a steep ask, isn't it?
I think one theme, I think the answer to your question is absolutely yes. And, I think the phrase bond vigilantes is frankly sort of badly used.
Probably buyer's strike is probably a better answer.
I think I would actually say investor caution.
Yes.
And, investors are being very cautious about markets where the budget deficit is high and there is no evidence that action is being taken to reduce it, where inflation is relatively high, and it's, if we have inflation north of 3.5%, that poses a real problem for the Federal Reserve. And we saw, what was in the FOMC minutes, which were published this week. And when the market is vulnerable because of the extent of foreign holdings, and also where you have that very heavy issuance, particularly at the short end of the curve. Yeah. All the warning signs are flashing. So what does that mean? It doesn't mean that bond vigilantes, and I don't like that phrase, but but it doesn't mean that big short positions are being taken on the Treasury market. It just means that investors are running very cautious duration positions. So, and that comes back to my point, Ben, that intervention only works when markets are very stretched. And is the US Treasury market stretched at the moment? And the answer is no, not at all.
Can we go back to, I think, what this is all far more important fundamentally than whether people are buying bonds or not at the moment. It's the fundamentals of the US economy, of the US balance sheet. If the fundamentals are good, then things will come back into line. If the fundamentals are bad or questionable, then people will remain with those questions that are being raised now. Plus the fact this is a long-term story. This isn't a Trump story. It's a Trump, Biden, Trump, Obama. Every pretty much government of this century has increased the debt. So go back to the fundamentals. Bessent has told CNBC that he believes there is a high chance that the deficit has peaked at around about 6%. You said this morning you think actually it's going to 6.5%.
Well, that's the recent data.
Yeah. So the question is whether the Treasury Secretary's comments are accurate or not.
I think the key question is not whether the deficit is 6 or 6.5%. The fact of the matter
there's
is,
a trajectory to get it down.
It is what is happening to get the deficit down. And we're not seeing any substantive cuts in public expenditure. We're not seeing any substantive increase in fiscal revenues. So if you ask the question, is the budget deficit in 2027 probably going to stay close to 6%? And frankly, it's a pretty irrelevant debate as to whether it's 6.2 or 5.9. The fact of the matter is, a rapid decline in the budget deficit is extremely unlikely, and that's particularly the case when two of the drivers of the US economy in 2026, which is the energy sector and also the tech sector, which have been real powerhouses of driving economic growth in 2026. In 2027, I think inevitably we are going to see, just because of base effects, some slowdown in the tech sector, and you see that in the corporate earnings projections. And yes, oil prices are high today, but don't forget that the IEA is forecasting an 8 million barrels per day increase in global supply in oil in 2027, assuming that the Middle East calms down. And that's a big assumption, by the way. But we could actually see less buoyancy in the energy sector, less buoyancy in the tech sector. So two of those major factors for the US economy are less powerful.
And as we saw with Walmart, the titan of retail yesterday.
Well, the consumer sector is weak.
The consumer sector is weak.
Yeah.
Which is a key part of the economy.
Yeah, and you saw that very clearly in the very good reports that come out from the University of Michigan. The Michigan Consumer Confidence Index, which had recovered in June and July, is now weakening.
Bob, is this Europe's moment, do you think, both in terms of the attractiveness of sovereign debt and equities?
Have you seen our debt to GDP?
Bob was mentioning, we were chatting in the kitchen, just outside the studio. We've got a little kitchen area. We were making a cup of tea about 5 minutes before the show, and we had the quickest of conversation. You said, what was it? You said, look at France. Look at France.
Okay, well, something's very interesting happening in Europe, which, everybody's focusing on the US Treasury market at the moment. But what's happening in the Eurozone? And two things are happening. First of all, as we have upward pressure on US Treasury yields, we also have upward pressure on Eurozone yields. So 10-year Bund yields, we're talking about, at the moment, we're trading at 3.25%. And at the moment, it looks unlikely that we are going to see a significant or short-term reversal downwards in Bund yields. So that's factor number one. Factor number two is that French yields are now trading at a higher level than Italian yields or Greek yields. And I think one has to go back a long time in history. I can't remember a time when France was trading at a higher level than Greece, and for that matter, Italy.
You know the answer to that, Bob.
And the answer to that's very simple. French budget deficit is 5.5% of GDP and not going down.
Because you and I sat here, well, we've sat here this entire century, well, actually upstairs, but because you and I were sitting here in 2010 saying there was a reckoning going on with the Greek economy, the Italian economy, the Spanish economy, and one or two others as well, but not the French economy as well. They never had that moment of reckoning that those other economies had.
Well, it's now happening, and you see that very clearly. Where's the pressure in the Eurozone? It's not just that yields are going up across the board, and in the short term, with somewhat higher inflation, I think that we will see somewhat higher yields, but we see now quite significant pressure on French spreads versus, you mentioned Spain. Spain is now trading significantly on a lower yield than France.
Yeah, it's fascinating. And what comes around goes around, doesn't it? Yes. Lovely to see you.
Good to see you.
Have a superb weekend, my friend.
Thank you.
And thank you as ever. Bob Parker, Senior Advisor for the International Capital Markets Association.
Still to come on the show, US Treasury Secretary Scott Bessent vows the toughest sanctions in history against Iran as Washington ramps up its economic campaign. Dan will bring us all the details. Plus, Anthropic reportedly eyes a bumper valuation for its highly anticipated IPO. And we'll be joined by Sean Pesh to discuss his latest stock picks. Don't miss that conversation, 9 o'clock this morning, London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
The US Treasury Secretary Scott Bessent has promised to, quote, collapse the Iranian regime, warning American allies that you're either with us or against us. Speaking to CNBC, Mr. Bessent also weighed in on the prospect of further military activity in Iran.
If we are doing the maximum economic pressure, then that means that likely there will not be a large-scale kinetic restart. But I would emphasize that is for now. And look, we do have control of the strait.
Dan joins us with more. Any response to that from the Iranian regime, Dan?
Not yet, Ben, but this is going to be interesting to watch. The Trump administration clearly now sharpening its economic campaign against Iran. And you heard there, Treasury Secretary Scott Bessent says the aim is to make a major return to military operations less likely. Bessent basically telling CNBC that Washington now plans to combine that U.S. naval blockade with what he called the toughest sanctions in history. The message to other countries is also getting tougher as well. If banks, companies, or governments keep helping Iran to move oil or money, then they could face US penalties as well. The Treasury now expected to set out more details on Monday. Here's the Secretary explaining.
We have a combination. It is a 1-2 punch. We have the blockade, and we are going to have the toughest sanctions in history. And I will tell you, this will work. It worked in Venezuela once we put up the blockade. It is working in Cuba right now, and it is going to work in Iran, and we are going to collapse this regime.
And that last line is really important there because it also goes beyond forcing Iran just back to the negotiation table. Bessent now openly saying the administration wants to collapse the regime. So the big question now is whether Iran's sanctions evasions network, especially oil sales to China, for example, the shadow shipping network, the alternative payment channels, the many things that Iran has done over the last decade plus to avert Western sanctions will slowly start to be peeled away, or if that infrastructure is ultimately going to stay intact and stop the US from being able to achieve its goals and ultimately blunt the impact of what could be coming on Monday. I think the bottom line here is that ultimately this really signals how the administration stateside has firmly shifted to pulling the tools of economic leverage now towards the regime as opposed to going back to kinetic activity. Of course, we're watching and waiting to see exactly what's going to be announced and whether it's going to have any impact inside Iran beyond just hurting average, everyday Iranians. It's back to you.
Dan, is this an admission that the military effort has failed then? And obviously there's concerns about US depletion of ballistic missiles and cruise missiles in any way, and let alone defensive capabilities with the Patriot system. But is this an admission that the war side of things is over and has failed, and now they need to turn to economics?
Well, the administration has said that its war efforts have been successful, and in many regards they have. The US has been able to degrade quite significantly Iran's ability to wage warfare in the Gulf states and elsewhere. But of course, that leverage that the Iranians have is still intact. And up until now, military activity alone hasn't been enough to get the regime back to the negotiation table. So now the White House is trying a different track here, one that ultimately will impact Iran's key trading partners, including the UAE here, and specifically China, which has long been a supporter economically and financially of the regime too. There are other countries that could potentially be in the crosshairs here, including Russia and even the EU nations. But exactly what is announced, again, remains to be seen at this point. And what type of support those countries that are called out will actually have for the administration's goals here also remains to be seen. Has the war effort ultimately shifted its track here? Then if the question is, is the United States trying something different now? The answer to that is absolutely. Again, whether or not this is going to work beyond just hurting the people inside Iran who have nothing to do with this conflict remains to be seen.